Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hello and welcome back to the Income Specials here on the Australian Retirement Podcast. In this interview with Tom Patrick from Barwon, you're going to discover how investing in property can produce a pretty consistent income stream. But we're not talking about residential property like our homes or apartments. We're talking about commercial property and what that can offer to investors. A lot of financial advisors use commercial property funds or commercial property in general to invest and attract a pretty reliable income stream for their clients. Don't forget, before you invest in anything like commercial property, it's really important to get financial advice. And of course, you can ask James and Drew questions. You can use the link that's available in the YouTube description, or if you're listening on a podcast, in your show notes link. Select the Australian Retirement Podcast. I hope you enjoy this episode with Tom Patrick on commercial property investing. Tom, thank you for taking some time to join me on the podcast.
Pleasure on. Lovely to be here with you and your listeners.
Yeah, it's not every day we get to chat commercial property and professional investing in property. A lot of the time we're talking about individuals going, into properties in residential. Maybe they have a portfolio and maybe they're looking to approach commercial property. They don't know how to do it. So today's going to be all about that. I would like to start this by you just telling us a little bit about your background and what led you into this part of investing. I'm assuming you could have gone almost anywhere, stock market, anything else. What led you here?
Yeah, good question. I suppose I professionally work in a segment of the commercial property market that's specific to healthcare real estate. So hospitals, medical centres, day surgeries, cancer facilities, a whole range of assets there. But at the end of the day, they're commercial properties. They're structured with commercial property leases in place, and there's tenants and landlords and so on. I have a broad background in commercial real estate over the last 25 odd years of my career. How I got to it really, well, I started out in credit, started out in banking, and I had some family friends that were investing into commercial property. To me, that seemed like an exciting segment of the market. The sort of hands-on approach to commercial property investing resonated with me. These are real assets as opposed to, equities on the stock market. You go and you can touch them, feel them, walk around them, get to know people that are using them, all of those sorts of things. So, for me, that suited my style of desire for a professional career. And quite honestly, as I progressed in my career, really what I was looking for was, I suppose, niche areas that I could be looking to take what was fundamentally a broad commercial property skill set and then start to apply that in a way that perhaps hadn't been done with as much institutional vigor and diligence and so forth to a segment or segments, as the case may be, of the market. And I think that's what I do. I think that's what my team does. I think that's what us as a firm does as well, as we look for, areas of the market that perhaps less competed, perhaps they're under-researched. You really got to go out there and turn over a lot of rocks to understand these sectors and understand how they work and the dynamics of them. But that can then lead to, competitive advantages and ultimately, hopefully, better investment outcomes for ourselves and our clients.
So as a fund manager investing in this way, investing in commercial property, you said with specific focus on healthcare properties. What is it that you actually do day to day? As in most people, I'm almost certain 99% of people that listen to this are not fund managers and definitely not involved in commercial property. So can you just tell us about what does a typical day look like? How do you go about things?
Good question. I think, there's certainly elements of this job and this profession that are unglamorous. I think people, when they hear about real estate funds manager, they think about the dynamics of transacting and acquiring or developing, commercial property. That's certainly a large part of what we do and what we all love to do. But equally, there's other very important, more administrative style elements to what we do. One thing I've always stressed with the younger members of my team is that fundamentally we're a custodian of other people's capital. We may have some of our own money invested in the funds, and in my case I do, but at the end of the day, we're managing money on behalf of other people, and that must be taken and treated with the highest regard and the highest respect, highest compliance, and the highest levels of professionalism. So we spend a lot of time in that part of the world too, administering the funds, reporting on them to clients, and just managing those funds, the vehicles themselves before we even get to the assets, valuation work, compliance work, making sure that, the properties are all in good shape and things like that. Then when we talk about our interface with the real estate market, we're looking to take capital that we've raised into our funds, into our vehicles on behalf of our clients again, and deploy that in a manner which will achieve the strategies that we've set out to achieve and ideally the returns that we've set out to achieve. So we're out there, in my case, buying healthcare real estate, commercial properties. We're looking to buy those assets in a way that will deliver the yield that we're hoping to get for clients and the total return that we're hoping to get for clients. Mm-hmm. There's a lot that goes into that, filtering through several $1 billion of assets in any given year to maybe acquire $150 million worth. You're talking percentages of the totality that you would look at throughout the year. So there's a lot of work goes into that. We're obviously valuing the assets and speaking with our advisors as well when we get into due diligence, things like that. There's quite a broad range of activities. Hopefully that's a fair summary. I'm very happy to dive into the detail on any of those elements for you. But,
that makes a lot of sense. So you're investing other people's money. So you've got obviously all the compliance, and I know firsthand how much fun that is. But then you've got obviously kind of the bread and butter property related things, the research that you're constantly doing. Just a follow-up question then, in terms of like when you get investors' money in the door and you're looking to make investments, have you and your team already done the research on which properties you want to buy when you go around and you ask for like more money to be invested?
Well, absolutely. There's a box. We're saying to clients, these are the types of properties we're going to go and acquire. These are the sorts of characteristics they will have. We don't necessarily have them all lined up. More often than not, we have one or two that maybe we're in due diligence on in the early stage when we're talking to clients. But what's really important is say, look, we're only going to acquire assets that have these sorts of characteristics, and paramount to that is, our I suppose forecast of the performance of that asset is critical, because that's going to dictate the sort of returns that we expect from it. Now, anything can happen. Donald Trump can invade another country. Goodness knows, there's always that black swan of things that will, upset your forecasts. But, we've done a pretty good job of getting that relatively right, I think. So, yes, we definitely define the types of assets. I think importantly also we define the types of transactions we'll do. I think that's really important for investors too, because that then defines the risk profile. For example, developing a medical centre, from a greenfield site in, pick the western suburbs of Melbourne there, really big, good growth corridor area. That's a very different risk profile from acquiring an existing medical centre in that same western growth corridor of Melbourne. It's a much higher risk. You've got construction cost issues, you've got planning issues and things you need to work through. So the types of investing we're doing is also well defined, as well as the assets, the types of leases, the types of tenants, and again, go so far as to talk about the amount of gearing or leverage we'll put into the transactions that we're dealing with, and all of that type of activity as well.
Yeah, that makes sense. And I do have a bit of a kind of like hopefully a bit of a checklist to run through with you, or at least a way to think about when you invest in a fund manager, like what to look for. But before we get to that, to set the scene for folks, can you just define like the landscape of commercial property? Like what are the typical types of things that people can invest in? And feel free to tell us at this stage, like why you focus specifically on healthcare.
Yeah, sure. Well, I mean, it's a broad segment. It's a very large segment. Australia has one of the most developed and highly securitized commercial property markets in the world. We've got very large listed entities, the REITs, the household names, the Dexus and Charter Halls of the world, GPT and some that people can access. They are liquid. People can trade in and out of those securities on a daily basis. Then you've got the unlisted commercial property market. That's managers like Barwon Investment Partners, where I am. We're not listed. The manager's not listed. The assets we own are not listed either, and they're unlisted vehicles, generally with less liquidity. So most investors coming into our fund, they're expecting to be in the vehicle for a 5-year period. They can, there's restrictions, but they can trade in and out of the vehicle at certain times, and we offer liquidity on occasions, annually, semi-annually, those sorts of things. Traditionally, office, retail, industrial have been the three pillars, really, of what people refer to as commercial property in Australia. What's been a very interesting dynamic over the last 5 years is that some of those traditional segments, office particularly and retail, have become less sought after, particularly by institutional investors. That's Australian superannuation funds or indeed global pension funds and things like that. And so we're seeing an emergence over the last 4 or 5 years of these more traditionally niche sectors, and that people are interested in. Healthcare property is one where we are. Data centers is another one that's getting a lot of interest really lately. The list goes on. The living sector, build to rent, student accommodation, retirement, manufactured housing estates, all of this type of things. They're all sort of have been traditionally, the purvey of smaller managers with less interest, are now becoming increasingly popular. So from our perspective, that's good news. We like more liquidity. We like more investment in our segment, does more for what we're doing. We've managed to invest about $2.5 billion of client capital in the segment over the last 10 years. And for us, why we like it is we get the same attributes that we can from the commercial property, the traditional stuff, the office, retail and industrial. We get good yield. But we would argue, and I think we've proven it to be the case, that in the healthcare segment, because of the tenants that are there, because those tenants are roughly, again, depending on the tenant, but 73% of the revenue that those tenants receive is paid for by our governments, either the state or the federal governments, in the form of Medicare or whatever it is. Because they receive a lot of their funding by the governments, they're less connected to the broader economic cycle and the machinations of the stock market or some of these black swan events. So they're going to be more defensive. They're going to find it easier to continue to pay their rents, pay it on time. And we think that's a lovely place for us to be investing. We're spending about $240 billion a year in healthcare in Australia. That's our sort of annual expenditure as a country. It's 11% of our GDP. It's second only in the sector in terms of our economy, second only to mining as a segment. So, the big part of what we do, we think there's a lot of interesting opportunity for us to participate in the real estate that goes with that. But it's a specialty segment. You must know what you're doing. You must know the tenants. You must understand how they all work. But if that can be done well, I think investors stand to do well out of that segment for some of the reasons I mentioned. It's defensive, but it also has growth attributes. We are a growing economy. More people are arriving in Australia every year. As a consequence, more people need health services. We're aging. The older people get, the more they need health services. So we think that augurs well for our little corner of the world.
Yeah, for sure. And I like that you can come here and give us that kind of explainer, because a lot of people, and something that a lot of people that listen to the show, and some of the people that kind of prick the hairs up at the back of my neck, talk about wading into commercial property, and they go and buy a single asset, not realizing that maybe the broker that set them up with the property or helped them find the property may be conflicted. The landlord is, also the tenant of the building, and then decides that they want to leave, and then they buy this asset that doesn't yield what they thought. And it scares me, to be honest, because a lot of people that maybe they're decent at residential property or whatever, but when it comes to commercial, they're just way out of their depth, and some of them use SMSFs and all this type of stuff. And, paying a professional to do it just makes so much sense in my mind. I'll come back to the properties in just a moment, but I've got one follow-up question just on the the role that you facilitate. And that would be, it'd be remiss of me not to ask you, that this is kind of an introduction, is how does a fund manager like yourself and the business of Barwon, like how do you guys get paid? Is it just a simple fee like you get with a traditional fund, or can you just walk us through that?
Fairly typical fee structure of most funds. So we charge a base fee. So that's pegged to the amount of assets that we're managing. That's a percentage of that, or in our case, less than 1%. We'll sometimes have performance fees in there. So if we're doing better than we had said we would, we're able to partake in that with our clients. But generally what we're doing is fairly core style, income orientated things. So there's not really a place for, performance fees like a hedge fund might get. And then we have transaction fees, excuse me, which incentivize us to go and source transactions and so forth and execute on those. So, that's a fairly typical, real estate funds management fee structure. We're a wholesale only manager, so it's important to note, retail managers will look a little bit different, and often the fee structure in retail for retail investors a little bit higher. So something to be mindful of. I'm sure your visitors will know what I mean here when I say the difference between retail and wholesale. But fundamentally, people that have got less than $2.5 million of investable assets or $250,000 of income per annum would be typically classed as a retail style investor. They must go through a PDS. We issue our products via an IM, and typically our fees are 75 to 50% less than a retail style product. And so that's how we're remunerated, and it's to run our business on the back of all that.
So if someone is considering investing via a manager in the sector, commercial property, one of the questions that I had for you is, like, how would you, as a professional in doing this day to day, and you've been doing it for a long time, what would you be looking for? Like, what are the key metrics, or just even the things that you look at?
Yeah, you've got to start with track record. Now, what's the old saying? Historical returns are not necessarily a guarantee of future performance. I think this is what the compliance people make me say, but it is a good indication of how an investor has, been going. So if they can demonstrate to you a good long, and by long I mean 5 to 10 year track record, doing what they're doing, then at the very least you're off to a good start there. It doesn't mean they're going to continue to do that, of course, but so I think track record's the first thing. From that, speaking to some other investors, I think is always really helpful. One of the things we find very beneficial is to, we pride ourselves on our reputation with our clients. And so therefore, if they're able to talk amongst themselves and just say, hey, have you had an experience with this manager? How have they been? How have they treated you? Are they respectful? Are they coming back to your questions quickly? Are they looking after you as a client? All of the things that, quite frankly, we get paid to do, and you should expect as a client. That's always a good reference point too, just to speak to some, if you can, other investors that are around, and because you're going to get a straight answer there. So those are two really important things. Outside of that, you get into legislative things. Have they got a license, or are they operating under somebody else's Australian Financial Services license? How are they promoting their products? What is the team like? And I think, a bit like commercial property in and of itself, you're making an investment into the properties that they own, but also the people that are operating. And so anyone coming to a manager must make a diligent assessment of the people who they meet. Do they seem credible? What are they like? And people need to use their own judgment there around that. And don't always go with, there's a thing called familiarity bias. Just because that person looks and feels like you doesn't mean that they're a good person necessarily. Just because they've got a fancy tie on, you could spend some time with them, really get to understand them and understand their motivations and things like that, and hear from their own thing. I think the idea of investing, via the internet on clicks of buttons is a little bit, it's okay, but the best investors, whether that's equities or property, you're out there, you're meeting the company, you're out there looking the people in the eyes who are managing your capital on your behalf, or it might be your children, and really getting a sense of who those people are and how they're going to look after things.
That's actually a really good point. And
probably one last one. If they turn up to a meeting in black Lamborghinis or green Lamborghinis, that let's telling you something too.
That's a green Lamborghini is a big red flag. Let's put it that way.
That's right.
But no, I think you touched on a few points there. One of the things is obviously making sure they're appropriately licensed. I think that's obviously just a hallmark of a professional, is like making sure there's a license in place, right?
Yeah, well, I mean, it's critical. And there are groups out there that promote real estate investment products that aren't appropriately licensed, or they're borrowing that license from another provider, which means they haven't gone through the rigors that, ASIC require of them. They haven't been able to prove their worth, and it's very difficult to get an Australian financial services license. Got to be able to demonstrate a track record and in custody and fiduciary obligations and so on and so forth. So, those are important things, and then they're there for a reason. They're a protection for investors in the market. Hopefully, we're learning from some of the lessons we've all learned over the years.
Yeah. So one of the things I was hoping you could do is kind of juxtapose residential property, like from a risk and return perspective. So a lot of people that write into us and ask us questions, they're really attracted to the yield of commercial property. So can you talk us through, if someone was familiar with resi, how that would compare to commercial? Even if you just take that through the lens just of the money that you manage and the strategy.
Sure. Well, I mean, that is the benefit of commercial property over residential property, is the yield that you receive. So I should know this, but I don't off the top of my head, but I'll give you a sense. But the weighted average cap rate of the ASX 200, REIT market, the listed market, it'd be around 6% at the moment. So that means that, investors, if they were just to buy an ETF that owned ASX 200 REITs, they'd expect some form of distribution at or around 6%. Now, that's the biggest comparison you're ever going to draw, because if you start to look at residential and a property in Australia, depending on where it is, very regional locations will typically yield a little bit more, but, major metropolitan areas, 3.5 type yields that you're going to get off the rent. And, my concern with that is even that is, particularly a place like Sydney, Melbourne, is unaffordable. There's a lot of talk about the cost of living crisis, whether that's the cost of your energy, your daily needs, or indeed your rents. Oftentimes now people are spending 40 or 50% of their income just on their rent, because the value's gone up, and, that's what it costs in Australia to rent these properties. So, with commercial property, you get a much stronger yield. There's pros and cons. You generally can't get as much leverage into a commercial property as you would a residential property, which you might leverage to 60, 70, 80% plus, whereas commercial property, typically 50 or below. But you're still going to get that yield on that basis. So those would be the biggest ones. I suppose the other thing to think about is just the duration or the tenure of the tenants. Residential property, people can turn over sort of every 12 months or so. They might come and go, and you've got to, work with your leasing agent, which is expensive. Most of those property managers are charging 10% or thereabouts. Oftentimes we're working with tenants that have 10, 15, even up to 50-year leases.
Oh, wow.
Yeah.
Wow, I didn't know it was that long. Okay. So you're getting a higher yield. If you've got good assets, you're getting more consistent tenants who hang around for quite a while.
Not all commercial property is the same, right? Let's be honest there. And a 6% commercial property in a yield is sort of ho-hum, or you may say that's a lower risk number. The commercial property yield is often relative to the risk. So if you were to buy, for example, a vacant florist in a very regional part of Australia, you would expect 8 or 9% yield, hopefully, to come. But the question is, will you get a tenant? Is there even a florist in town that wants to take that property? You might have to spend some more money on it. You might have to do this, that, the next thing. So, they're not all created equal. But, as a general rule around that is the thing. Now, the other important point to make out is people need to think about what sort of return do they want? Do they want capital growth, or do they want yield? Depending on where you are in your stage of life, if you're a younger person, perhaps you're after more capital growth. You want to take the money you've got and grow that, try and double it, triple it, who knows. If you're an older person, perhaps you're more in retirement mode, yield is important. You want to cover your daily needs, cover your costs. Therefore, commercial property does probably sit a little bit nicer. I'm a bit of a bear when it comes to residential Australia. I do own a house. My wife convinced me to do that, but you can't fault it. The capital growth, the residential property markets in Australia have been extraordinary. There'd be few people around Australia who could say, hand on heart, that their home was not the best investment they ever made. So we can't ignore that, but it is a question of what does the investor want? What are they trying to achieve? What are their requirements?
In terms of, imagine someone, Tom, has like a portfolio. It's like well diversified in the traditional finance sense. They've got some shares, they've got some bonds, they've got some cash. And let's assume that this person is like retirement and they're seeking that income. Where do you think a commercial property, like say one of the funds at Barwon offers, like where does that sit in terms of like the risk spectrum? Is that something that you would put in maybe like an alternatives bucket? Is it something like somewhere between? Is it lower risk in terms of the income stream or higher risk in terms of more like equities or shares?
Yeah, great question. Working risk spectrum lower to higher, equities and so forth are typically, the share market is a higher risk, higher returning element. Moving down, you start to get into, bonds, cash and things like that, which less risky. Commercial property is typically what investors refer to as an alternative segment. So that's private equity, property and infrastructure generally get put into a bucket. Doesn't mean the risk profile is the same, but that's where people will allocate across their portfolio. Let's say equities, international and domestic equities, cash and bond-like structures that have been yielding and fairly safe. That's obviously cash in the bank's the safest thing you can get, or government bonds in that case. Property slightly higher risk, but also slightly higher yield. So a bit like what we were talking about before with yield on the thing, cash rate in Australia at the moment, what is it, 4.5%, thereabouts. You should be getting traditionally around about 150 basis points over that from your commercial property. Again, very general rule, but it's an industry rule of thumb. So if the interest rates were 3%, then commercial property should be doing at the very least 4.5%, right? To allow for the slightly more the more embedded risks that come with it, because you're not always going to have a tenant. Risk-free rate being the Australian government bond, they should always pay the bills, they should always pay that interest that they need to. So that's where we see it, and most institutional investors have that sort of scope within their portfolio allocation. Yeah.
In terms of finding properties, like, particularly with you and your team, when you're looking for healthcare properties, and you mentioned you turn over a lot of rocks, and you mentioned gearing earlier, and I think that's probably something that it's worth talking about as well. Like, so how do you go about finding these assets? I imagine because, like you said, it's getting more attention. I imagine most of these properties are kind of like out of range of like individual investors, even if they're of means. So how do you go about finding them? How do you finance them? Just generally speaking, I know it's a high level question, but I'm just interested.
Right, sure. Yeah. Well, I mean, we've been doing what we do for over a decade now. So, we're paid to do it. I think we do a reasonable job of it. We're able to secure a lot of the assets that we acquire in what's referred to as an off-market fashion. So we're dealing directly with somebody who owns a building. There maybe is not an agent involved, not 10 other buyers lining up for it. That's where we're dealing with a tenant that has a property on their balance sheet and they want to sell that off. So we do quite a bit of that. That being said, we're still active on-market buyers as well. So that's where we're working via an agent who is acting on behalf of the vendor of a property to sell that to the market, no different to a house. And then, of course, there's auctions as well. We're typically targeting properties that are, generally 15 million up to 350 million. Equally, we have bought plenty that are smaller, 1, 2, 3 million. We don't love doing that, but we do it. How would people access commercial property? There's a couple of real estate agencies out there that run auctions that they can look at smaller properties. Let's say a person had $500,000 to invest. They're up with a bit of gearing because you're only going to be able to get about 50% gearing in the commercial property. Let's say you took your 500,000, a bit of gearing from ANZ or CBA. You're going to have $1 million worth of purchasing power. You can go toddle along to one of those auctions and buy some of those sorts of smaller commercial properties that are out there. People can make their own decisions on whether that's a good idea to do or not. Certainly going to need to know how to manage that asset then, how to lease it, how to continue to keep the income coming through with the tenant. And landlords have certain legislative obligations that they need to be mindful of, insurances, things like that. Or you can go to a professional manager and take the 500,000, or it might even be 100,000 or 50,000 or 20, and give that to a professional commercial property real estate manager, be that somebody like us, and we'll take it, invest it into healthcare, or somebody else would be able to buy storage or office buildings for you, and you get a percentage of those. Now you pay for that, and so if they're worth their salt, a bit like what we were talking about before, and they could demonstrate a good track record, you should be able to get the returns out of that I can measure it with, if not better than what you might be able to achieve yourself. It's not for everyone. Some people do like to be active, and certainly there's plenty of wealthy people in Australia that own loads of commercial property, are quite good at it. But if it's a first-time buyer, just know that there are options. You don't have to go and do it yourself. You can work with managers. I think we've addressed some of the things to look for when you're thinking about a manager to take your hard-earned cash and go and invest that. People should be as diligent in selection of that manager as they would be in selecting the property that they would buy themselves anyway.
One of the things is the idea of gearing, or like leverage. Yeah. How do you and your team determine what is like a reasonable level to use in terms of the portfolio that you're running?
Okay, well, the starting point is how much will the banks lend to commercial property opportunities anyway? And that'll change a little bit. They're typically at 50 to 55 is where they're pretty comfortable. Anything less than that, they're going to be happy with. When you start asking the domestic banks for 60% leverage on a commercial property, they start to get a little bit unsure. They'll do it, but they'll put some conditions around that. There are other options, including the private credit market. People can go to other fund managers that manage debt, borrow at 65%, and there's mezzanine and all sorts of things. You can gear it right up if you'd like to. It's going to cost you a hell of a lot. And that's not appropriate generally for a long-term hold on a property. So, from our perspective, what we've always wanted to do is kind of match the debt with the type of risk that we're taking in the type of commercial properties we're buying. More leverage means more risk, because there's a greater chance you're going to lose your equity if there's a problem with that asset. You've got to pay the bank first, right? Then you get paid. So less leverage, less risk. Less leverage, less return. More leverage, more return. So we'd like to strike a reasonable balance there that we think is reflective of the type of investment that people want to make. When they're coming to us to invest in a commercial property, they're typically saying, I'd like some yield. I'd like you to protect my capital, invest in a prudent way into assets that are low risk, that are going to have some growth, but I just don't want you to go off and do anything too exciting. Thank you very much. Now, for us, we should be then matching the debt profile that we're taking on board with that requirement. So that means for us, we keep our leverage at around 40%. We could be a lot higher, but it's a fair balance, we think, between delivering a little bit of return, a little bit of extra return through from the gearing, without taking on additional risk.
Because I remember prior to starting this, Tom, I worked for a research house, and we used to research property managers and equity managers and everything. And you still saw a few years later a lot of the kind of fallout from things you see. Yeah, Zenith, yeah.
Okay.
Yeah. And you could see some of the bad experiences that people had from over leverage and from the GFC, quite a few years later. And that's why the type of leverage that you're talking about is like well within the band of like what would be considered reasonable and like you said, a good balance between.
Let me share some horror stories for you, not to specialise things, but the Australian property market is not characterised as being over leveraged. I think we've learned our lessons from the GFC. The US market, the European markets at the moment, however, are and have been highly leveraged. If you just do a little bit of Googling around, if people are interested, have a look at, type in horror stories, office building, or something like that in New York. People are selling office buildings for 50% of the value of the debt. Hundreds of millions of dollars of office buildings that are being sold for $1. I'm not kidding, $1. Fifth Avenue, New York, because they've had so much debt on that asset. The market's declined, the value's declined. They haven't wanted to put more equity in to solve the problem, and the bank has said, "Sorry, we're calling that in and we're selling it off." There are some real horror stories over there. Property is an illiquid asset class. It's not easy to, just shake things up, change things, and deal with something. So they're real assets. You've got to be very mindful of not over leveraging them, and they're long-term assets too, right? So this is one of the things. If people have only got short-term debt, if you're thinking of a fund or even your own exposures in commercial property, you've got to be mindful. There's only 12 months left on that loan, and yet the tenant's there for another 5 years, 3 years, whatever the case may be, or indeed you want to hold it for another 3 to 5 years. You've got to recycle that capital. The bank will need to be either paid back and another bank bought in, or they'll be happy to renew. And where people get caught out is if the credit markets are challenging, like they have been in the past, and you go to renew that debt, you say to the bank, "Hello, I'd like to just roll that over, please." They say, "Well, actually, we don't want to roll it over." Well, don't make the assumption that they will necessarily be there. And that's where you get the issue, because all of a sudden 50% of the capital in that property needs repaying, either replacing with another one or whatever. And the rate's guaranteed to go up. The transaction costs will be high, all of those things. That's the concern you need to worry about. In the US and things like that, where they've had leverage at 75, even 80%, all it's taken is for the commercial property to drop by 20% value. Like, think about Australian office buildings. That dropped 30-odd% as a general number. Now, if you had your leverage at 80%, all of a sudden you're underwater. You need to put equity in to solve that solution. And there's been quite a bit of that going on in the United States, unfortunately, and Europe as well.
Wow. Well, that just illustrates perfectly the benefit of using a professional in this market. And I think a lot of people that have the expertise in residential, those skills aren't necessarily transferable. You mentioned that it basically cookie cutter with a mortgage now on a home. So it's very different to lease contracts, legal, all this type of stuff that goes into being involved in commercial property. The other one I would probably point out as a key advantage, I don't know what you think about this, it's just diversification. I don't know how many properties you have in your portfolio and what your team manages broadly, but that would be substantial, I'd imagine.
Yeah, I mean, we have over, depending on the fund, but one fund has in excess of 50 commercial properties, the other one has 30 odd. And the probability, I suppose, is what you're getting at there, the probability of a problem in one asset then consequentially causing an effect to the returns of the whole fund that is lower. Or if you just own one asset and something goes wrong, well, that whole investment has gone wrong. That's the benefit of the diversity that you speak of having a robust portfolio. Yeah.
Yeah. Tom, I've just got one more final question for you. But for anyone that's watching and wants to learn more about Tom and Barwon, I would highly encourage you to check out the website. I'll put a link in the podcast player. If you're on YouTube and watching, it'll be in the YouTube description. And you can go and see some of the literature. You can see profiles, different investment strategy, learn about the team, all the things that we actually have talked about, you can go and check out on the website. So that'll all be available in the show notes for folks that are watching and listening, Tom. But my question is, if there's an individual investor who's new to commercial property, what are the first steps that they should be taking if they are thinking about getting involved? Like you mentioned, is it as simple as just see what else is out there, consider your options? What is that first step they should take?
Yeah. I think the first step people should take is to ask themselves some honest questions. What do they know about? Making a serious investment decision. They want to be informed. What do they know? Now, and the answer back to that might be, well, I don't know, use the example of perhaps a mechanic. Mechanics know cars. They know, mechanic buildings. Well, it might be a really good place for that person to start by actually looking at commercial property opportunities within their little corner of knowledge. Car yards, mechanic shops. I mean, I know that sounds crazy, but just about everybody listening in today will be informed in some way, shape, or form, and probably have a little, an area of the world that they know a hell of a lot about. Take that knowledge and apply it, because you'll be miles ahead of everyone else already from step one. Step two, then you need to get advice. Even we use advisors. We have valuers that help us through, give us really good market information. Market information is the thing in commercial property. It's like gold. The equity guys, the stock traders and things, they can dial into their computers and they can pull up trades and work out what's going on in the blink of an eye. You can't do that in commercial property. You have to talk to people. You have to have a network of people around you that you can ask advice on. Hey, that building down there, how much did that sell for? When did it sell? Who bought it? How much rent was being paid? Who was the tenant? How long were they there for? All of those sorts of things. So just start informing yourself. And then just start watching the market, right? Going along to, the auctions, going on to, realestate.com.au and those sorts of places, just keeping an eye on things. And, because you don't often say that the most important part of a commercial property transaction is the commercial property transaction, the actual buying of that asset. It's very hard to fix things once you've bought it. At least you've identified them up front and allowed for that in your price. Maybe there's some roof tiles that need replacing, some broken windows, whatever it is. You need to allow for that. Otherwise, you're just going to pay for it and you're going to lose out. So there's a lot of work needs to go on, but I would suggest that people, seek good advice, speak to their accountants, make sure they've got a decent lawyer around them, and just go out there and see what options are available, start to get a sense of the market, talk to people, and consider whether, do you want to be doing this yourself, or indeed do you want to do that with a professional manager? There's plenty of them around that are good. But again, I'll reiterate it. Make sure when you're picking a manager, if that's the way you choose to go, that you do your due diligence on them. Call them up. Say, I'd like to have a cup of coffee with the guy that's running this. I'd like to meet him. You're absolutely entitled to that. They may be in a fancy office building in Sydney, but so what? Go and see them. Together, get comfortable. Get comfortable that they're going to do the right thing by you.
That's great advice, mate. I really do appreciate that, because there's often a lot of mystique around it, and I think people feel like they can't do that, but this is like a long-term commitment. It's a long-term asset class. You're handing over your capital, right? It's your money. So I'd also probably just reiterate and summarize something there, which is just that before doing anything, consider very strongly that what you just said is, do you want to do it yourself? Like, I think if that's the question in yourself and looking in the mirror, it's, do I want to do this myself? Or do I want to allow a professional to do this that's licensed and has done it for a very long time, and then maybe apply my craft somewhere else? Maybe if you're a mechanic, go and start a mechanics business or do something like that, because I think this is one of those areas, to be honest, mate, where we're dealing with bigger check sizes, and it's easier for people to get lost in it, as opposed to spending $5,000 on an ETF or an index fund, or of 20 grand on an equities fund manager you can redeem in a few days.
There's so many options. That's right. People need to think about what's best for them, what their circumstances are. Either they've got a financial advisor or they don't. They have a financial advisor that must talk to them. If they don't, they need to think about those things. Properties are liquid, and if liquidity is something that you need because you don't know what's coming in your life or your children's lives, then you probably want a liquid option. You can still access commercial property by liquid options, ETFs, REITs and things like that.
Yeah, good point. Yeah. Well, Tom, this has been very insightful, and I'm really appreciative of you taking some time out of your busy day to chat with myself and everyone on the Australian Property Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.